Hello, I'm Demetris Theophanides, Director of XSpot Partners Ltd. Today we will analyze the macroeconomic picture of the global markets for the month of February and the performance of our portfolios. On February, bond portfolios outperformed equity portfolios, mainly due to concerns about the impact of tariffs and fears of a significant slowdown in the US economy. Our income-based portfolios, income and high income, which are primarily focused on short-term bonds and high dividend-paying stocks, had the best performance for the February and have been the top performers for the first 2 months of 2025. Specifically, the income portfolio had a return of 3.51%, while the high income portfolio had a return of 4.63%. 2025 started on a strong note for the US equities. Stocks rose throughout January, with the US index peaking at 4.7% year-to-date gain on February 19th. Since then, US markets slipped steadily and underperformed major global indices. As of the beginning of March, the US indices have turned negative compared to the start of the year, while indices in Europe and China are performing much better, with returns exceeding 50% in China and 20% in Germany. Even though interest rates remain excessively high, we are observing a recovery in major markets that underperformed in the last 2 years compared to the US markets. What seems to be worrying investors related to the US markets is the Federal Reserve is keeping interest rates at unreasonably high levels, while inflation is on a downward trend. In addition, following the latest round of tariffs imposed by the US government on other countries, the economic uncertainty increased. We suddenly saw the GDP now, which is a real-time model measuring US GDP, dropping from positive 2.2% to almost negative 3% for the first quarter. The gap between the plus 2% and the negative 3% is significant and can have serious consequences for the markets. The fact that the US president constantly announces unpredictable political and economic decisions creates confusion and uncertainty, which does not help the markets either. Some investors are currently turning to other regions such as Europe and China, which have underperformed in the past year compared to US markets, but are maintaining lower interest rates and thus providing a sense of security regarding the direction of the markets in the coming period. As we approach the end of the quarter, we are likely to see increased volatility and some capital reallocations across different markets. Yet, there is still a scenario that some macroeconomic data, to be announced by the end of March, might not be as disappointing, which could give large investors the opportunity to re-enter the US markets. After all, the labor market in the USA remains reasonably firm, and some expected tax cuts and deregulation may improve the economic sentiment and reverse the downside trend. We're here to monitor developments and the performance of the portfolios, which, thanks to their diversified exposure and strong fundamentals, are expected to deliver decent returns despite volatility. When markets are volatile, it is important to stay calm and avoid making impulsive decisions. Investors should avoid timing the market and stick with their long-term investment strategy. Thank you for watching another video analysis from XSpot Wealth. Stay tuned for more videos to follow.